So today I've got a special video for you guys. We've got Martin Sorrell, who was earlier today spending half an hour answering some questions. I'd like to thank Sir Martin for coming on to the YouTube channel and answering these questions and spending some time sharing some information with shareholders. He gave some really good information on what's going on in the industry, what's going on with SR Capital and the future of where he sees the company going. And I'd just like to apologise, actually, the first minute of the recording actually did mess up. So the first minute isn't in the video, which does miss out the kind of introduction and me asking the question about what he's kind of seen in the industry at the moment. As someone that is very much involved in the industry, what insights can he share? So you'll see the interview pick up from there. Hope you enjoy it. Let's get started.
So what you've seen with us is our bigger clients, and we have a client list to die for, which people give their right arm for, dominated by tech clients. But even in the tech clients, it's been patchy. I mean, some have been up, some have been down in terms of marketing spend. But the irony about all this is what's been happening in the media industry generally, because overall the media industry, which is about $900 billion, is up about, this year will be up about 5, 6, 7%, depending on who you believe. But if you break it down, analog is down at 7 or 8% or 9%, and digital is up 6 or 7%. And digital as a proportion of the whole is about 60%, 2/3 now, and will be 75% by 2025, according to the so-called experts. But the platforms, Alphabet, for example, which is our largest client, Alphabet in the first quarter was up 3% like for like in ad revenues, and then 6%. Meta on a recovery streak in their year of efficiency, up 3% and 12%, I think it was in Q2, and Amazon up 22% and 21%. Alibaba and Tencent, we don't get granular data. I think TikTok probably outside China will be about 14 billion this year versus 10 last year, from what I see and hear. So the platforms, we think this year will grow by about 10 or 11%. I think 10.9 is a figure that Scott Spirit had in the average of the sort of consensus analysts forecast for the platform. So the irony is that whilst the tech companies have been varied in their spending, some up, some down, their ad revenues have been increasing quite substantially. Analog, not so, has been down. I mean, you see Disney talking about the sale of ABC or joint venture with somebody on Hotstar in India. So analog has been under huge pressure. And where is all this spending coming from? I think it's basically coming from packaged goods companies, because during an inflationary time, packaged goods companies can get price increases to cover their increased input costs and maintain margins. And so if inflation is 10%, 5%, 6%, 7%, they increase their prices to compensate for that. And we've seen some of the big packaged goods companies up 10, 15, even 20% in terms of prices. And their ad budgets are priced off net revenues, nominal revenues. So if prices rise, their ad budgets rise as well, because they have a fixed percentage in many cases of revenues. Sometimes some are even increasing the percentage. That increase in spending in the first half has gone into the platforms. It is clear that digital marketing is becoming more and more important. I said it'll be 2/3, and of course it's dominated by Alphabet at about probably this year 220, 225 billion. Meta probably 120, 125, maybe even more billion, and Amazon 45, maybe even getting up towards 50. I think we'll go eventually to 100, driven by the growth of retail spend. And then the three Chinese are also doing well. As TikTok looks as though it'll expand quite significantly this year outside China. So that's the anomaly here. But having said that, I think overall, going beyond consumer goods and beyond tech, clients are keeping their hands in their pockets, because the world is an unstable place, or a dangerous place politically. US, China, Russia, Ukraine, Iran. It's a dangerous place politically and geopolitically, and it's a dangerous place economically. And we have a lot of uncertainty. I mean, who's going to win the American election next year? who's going to win the British election this year. Britain is less important on the world stage, obviously, than America. But all this conditions thinking. And you heard last night from Carolyn at ITV, Carolyn McCall, that she's concerned about TV ad spending, so that's linear free to air in the UK in the second half of the year, because people are uncertain about the political future, they're uncertain about the investment climate as a result. So I think all in all, clients are keeping their hands in their pockets. Now, that was the case certainly for the first half. Whether that continues post Labor Day into the second half, we'll see. I mean, there are some encouraging signs on the stock market, as you know, in terms of Instacart, in terms of Arm and the IPOs that take place, encouraging in terms of deal activity, Smurfit, etc. We're seeing Advinta. I mean, there are things happening that indicate a little bit more activity. But my own view is things are going to remain pretty much as they are, maybe improving a bit in the stock markets. I mean, if interest rates do start to fall in America in Q2 or Q3 of next year, despite what the Fed said this week, if they are going to fall in Europe towards the end of the year, will be slower for Europe, because Europe has higher inflation and probably is stickier in terms of the post-COVID, and recessionary situation. But if that does, the stock market should improve, and then the real markets maybe improve after the elections. We'll see when Rishi Sunak decides to go to the country. My bet would be probably the autumn next year, but we'll see, with a favorable spring budget for political reasons, and then we'll see what happens in the election in America. I mean, if the economy remains strong in America, I think Biden has the best chance if he's the nominee, which he will be. And if Trump is the nominee, not as certain that, but it looks as though he will be the nominee, then I think we'll have to see what happens. I don't think Trump is bad for business. I think that's what American business basically feels. Whatever you think about him personally, and people have very, very polarized views on him. He is Marmite. But having said that, he hasn't been bad for business because of low rate, low tax. So that's my overall view. I think people will keep their hands in their pockets in the near term. But the markets, which are 6 months, a year in advance of reality, may improve as interest rates come down. We'll see. Yeah, but I would underline that the people we talk to, the institutional investors, the PE people, the strategic competitors, I think there's a considerable degree of uncertainty, and that's what's dimming people's views. I think the thing to underline about S4 or Media Monks, our operating brand, is that our large clients, our core relationships are strong and growing. And we had a review yesterday of our key clients, and there are ups, there are downs, and there is an overall balance. But the larger clients, where we have more visibility and obviously stronger relationships, those look in pretty good shape.
Yeah. Great stuff. And actually, on your first point there that you were making, though, actually the growth that you actually put in at the start of the year is actually quite impressive, and I think that's been overlooked at the moment, considering.
We have shot ourselves in the foot over the profit warnings, obviously, the audit issues that we have, and clearly we have more work to do in that area in various parts of our business, and particularly in the content part of our business. Our margins in the first half were just not acceptable, and I think in data and digital media they were better. They were okay. They could be better, but they were okay. In tech services they were very good, but in content, we had a pitifully small margin. Now, we are seasonally biased. I mean, in the sense that we do get the majority of our revenues in the second half of the year, and it can be as much as 45-55 as a split overall, maybe even less, 42-43, 57, 50, 56, 57, 58. So you've got to split it into two halves. But our reported profits were up. The EBITDA profits. I mean, analysts and the press and the media, Bloomberg, for example, quite rightly focus on reported profit, but we look at operational EBITDA because we have. I think it's important to understand we still have consideration payments, combination payments, merger payments we're making in 2023, and because we tie those payments to continued employment, we have to expense them through the P&L. In other cases, under accounting principles, they're not expensed to the P&L. So the reported profit is more akin to what we call our adjusted operating profit or adjusted EBITDA, operational EBITDA, which in the first half was 37 million versus 30 last year on a reported basis, although it was down on a like-for-like basis, and obviously not acceptable from a margin point of view. But all the dire things that people say, when you actually look at it closely, you look at the growth of the large clients, the core relationships around our top 20, top 50, top 13 clients, which are over half of our revenues. If you look at the spread of those clients, they are tech dominated. It's true, it's about 44% of our first half revenues. That excludes telecoms, by the way. With telecoms, probably be about 46, 47. But when you look at the core, when you look at the clients, when you look at the quality of them, it's not quite as bad as it's portrayed.
Yeah, 100%. And I was actually looking that your operational EBITDA margin targets was actually to return to 20%. That's correct.
Well, yes. I mean, that's, I would say, ambitious, but feasible. I mean, I was talking to somebody this morning about, how we see the margins and content. We do think can get back to that level. Our data and digital media were respectable in the first half of 15.3, and the tech services was a blowout in terms of margins. Probably not maintainable in the longer run, but certainly maintainable at that 20% plus level. I think the biggest challenge on the margin side is the content side of our business, which is almost 2/3 of our business. So it is the most important practice. Yeah. But what we have to do is, we have to get our pricing right. We have to get our scopes of work right. We have to avoid unbillable hours and unbillable work. We have to avoid reworking. If a client changes their scope, we had a conversation with one of our biggest clients this week about how important it is to get the briefings right. Clients often don't develop a brief or a scope of work in as much detail as we would like, or is feasible, and we don't tend to down tools if the client alters the scope of work or is not satisfied. We tend not to down tools like some of the consultancies do, and rework the SOW. We just tend to do the rework. We tend to add billable hours to an estimate that was previously agreed, and which, given the change in the scope of work, has changed by nature. So it's those sorts of things, and then allocating our resources more efficiently. I mean, in a way, to use a grand example, we really got to do what Mark Zuckerberg and his team at Meta have done this year, and move towards a year of efficiency, and that's particularly the case at our content practice.
Great stuff. Yeah, and that's actually going to lead perfectly onto what I was going to ask next, which is I believe that you announced you could get close or near break even in profitability in 2024 in the interim press release. Is that from
so what do you mean break it? What do you mean break even, bro?
Cash generative in
no, that's not right. No, we set it's not break even. I mean, we've been cash generative in the first half. I mean, for example, net debt interestingly in June 30th of last year was about 135 million. Net debt the 30th of June this year was 109 million. So we've been generating cash even with the merger payments that we've had over the last year. What we said was that in 2024 we have no more merger payments, and therefore we will have considerable free cash flow available for the obvious, share buybacks, given where the share price is, and the obvious in terms of dividends. I mean, dividends are a bit more controversial for shareholders. Some shareholders prefer share buybacks, but that will be the focus. And we said in the statement that depending on the results for the full year, the board would consider a minimum of a 1p dividend. But really trying to use the cash flow next year in particular to buy back stock and implement dividends, I think is important.
Yeah, because that was why.
So it's not. So it's not true to say, talk about break even. What we're saying is that we will be highly cash generative. I mean, our objective, we have set an objective for our people right across the company in terms of the S4 financial objectives and qualitative objectives. We set an objective of cash return, a significant cash return, and we should be in the area of 65-75%, maybe even more, in terms of cash flow generation, percentage of cash flow that we convert into cash, or percentage of profit that we convert into cash, because it is a highly cash generative business with limited capex. I mean, obviously, office costs post-COVID have come back again to some extent. We'll see how much further they come back again. T&E has come back again. So some of our indirects, we've seen a little bit of salary inflation, as we said in the statement for the first half, and related benefit cost inflation. But given our revenue growth, that has not been sufficient in two of the practices to cover the cost growth, but tech services have managed it pretty well.
And I guess that confidence to grow that bottom line really is then shown with the suggestion from the board potentially of the dividend, and obviously capitalizing on where the share price is at the moment with those.
I mean, there's a lot of media focus on the reported results. And as I said, if you look at it, it's £1 billion business with very strong client relationships and potential for more. The strategy is right. We're in the right place. As I mentioned before, analog is in trouble. Digital is not, and is continuing to grow. So having a purely digital business driven by data, which is our second sort of foundational principle, which is core for AI. I mean, you shouldn't call it the oil because it's fossil fuel, but the electricity or renewables of energy of AI is around data. So that's core, and our people are very good at that. They're very good technologically, as we saw with the announcement last week in Amsterdam of the NVIDIA, AWS, Adobe partnership on outside broadcasting. So if you have usually people for outside broadcasting, sports, basketball, whatever, entertainment, music, use trucks, which cost something around $7 or $8 million each, with a cloud-based computing, AI-generated execution. You can reduce that cost to 100,000. The 7 to 8 million probably gets amortized over a number of years, but you can reduce that to $100,000, I am told, through this new execution. We're getting a huge inbound and outbound interest from obviously media companies that do outside broadcasting and associations that do outside broadcasting to look at this. So that's an example. It's AI generated in part. That's an example of the deep technological knowledge that our people have, which matches some of the best that you see, given the partners, obviously, that we're working on that particular project and others too. So it's $1 billion of revenue, strong client relationships, margin has to be improved. It's not acceptable to be in 11, 12%. That's not where we want to be. We want to be back to where we were at 20, 21% after central costs. So we have a lot of work to do, particularly in the content area, in terms of, as I said, pricing, around scopes of work, about eliminating unbillable projects and unbillable resources, and avoiding duplication and integrating the business even more than we've done.
Yeah. And I see there was a 5% job reduction, wasn't it? That was in the interim results.
Yeah, yeah. So again, media focus, I say, is cutting jobs. Well, we've gone from 1,500 jobs to 9,000 in 4 or 5 years.
Yeah.
And that's come through mergers and through organic growth. I mean, organic growth rate in the first year was 40%. Then in the COVID year was 20, when everybody was flat on their backs, up 43%. Then last year, 26%. And we're now, we said we will probably be 0 or less than 0 for this year. Now, that's considerable growth, and we've added a lot of headcount. And just like the tech companies that probably overexpanded or expanded with the stimulation, the massive fiscal stimulation that governments made, quite rightly, to try and deal with COVID. Some argue they went too far. That created, a bubble, and so we've trimmed ourselves.
Yeah, and I'll keep this nice and brief because I know you're a busy person right now. So I'll make this my last question.
Sure.
Ultimately, looking at the company gets enough credit of the progress it has made. It's made a lot of progress, as you said in this interview. It's done fantastic. I'm looking at the valuation, even though, sure, as you said, there's been some issues around the profitability side of it, which should recover. I'm still looking at the current valuation. I think this is a very low valuation for the amount of good progress this company has made. I was looking, operational EBITDA for the trailing 12 months is something around about 3 times. I think analyst targets around 100 million in free cash flow for the end of 2024. I remember back in 2022, and obviously you're using your buyback, or potentially looking at buybacks to take advantage of the current levels, what the stock price is at. I remember in 2022, you're saying that potentially you could unlock more value with looking at a New York listing. Is that something that is?
No, I think. Look, I mean, in an ideal world, we inject ourselves into a US-based company strategically strong. That would be very interesting. But this suggestion that US listings are the magic panacea to valuation issues, I think is wrong. I mean, a lot of American companies have higher valuations because they have very good records. For a company our size, even if our valuation was what we all understand to be the intrinsic value, even if our valuation was that, we're a relatively small company in the context of the US. What we have to do, the numbers never lie. What we have to do is to get the numbers right and build the proper performance, the proper margins. Not just have our top clients growing, but our local and regional clients. I mean, where we've suffered this year, I think, is not been compression of our bigger relationships, but compression of our smaller ones and regional ones, where the uncertainty, has made people, the froth has come out of the market, if you like. The buzz has come out of the market, and it's a more realistic environment in relation to fears around recession. No, but what we've got to do, I don't think, not be diverted by US listings or things like that. I mean, it is true that, there's a problem in the London market, because if I said to you or asked anybody who's listening, how many companies, UK FTSE companies, are in the 100 most liquid companies in the world, the most actively traded, the answer is, or one answer I got a few weeks ago was just one, Unilever.
Yeah.
So one out of the 100 most, we know that Amsterdam and Paris trade at higher levels than the London Stock Exchange on some days. So the UK market has a liquidity issue. Institutions have gone from equities to bonds to fund their pension liabilities or their long-term liabilities. Even that can go wrong, as we've seen. After the trust courting debacle over their sort of mini budget, and I think it's a full swing. I mean, it's a lot of time, it's a lot of effort, it's a lot of expense, and it diverts you from the fundamental, which is to get the business right. What we have to do is get the business right. But you can look at the forecasts for profitability. You can apply EBITDA multiples, that get talked about in relation to companies, and then knock off. We've said our net debt position will be 200 million after all the in the range of 180 to 220 million. After all the merger payments are made this year, you can do your own maths on that. You can work out what the appropriate multiple is. You can take the EBITDA, take off the debt, and you come out with an intrinsic value. And I'll leave people to figure that out for themselves.
Yeah, that sounds great. It sounds a great point to end on there. And it sounds like you've definitely got your game plan and what you're focusing on the next 1 or 2 years.
Don't know. We have to implement. We haven't been very good on execution in some respects. not across the board, and we just got to get that right.
Yeah, sounds great. Thank you so much, Sir Martin, for joining us.
Thanks, Jacob. Sorry, I was a bit delayed. Thanks very much.
It's okay. I appreciate it. So yeah, thank you so much.
Super. Thanks very much.